Welcome back to Jacksonville's Retirement Coach, the playbook for retirement here with Adam Wolf, the president, CPA, and CFP of Wolf Retirement Navigation. And Adam and the team would love for you to log on to wolfretirement.com. I got to say this. You guys do it right, all right? The graphics look good. The site looks good. It's splashy. It's got all sorts of clips of you doing TV locally there in Jacksonville, Adam. Do you enjoy getting to come up here to Atlanta and film a little TV with Dave and Mallory?
Yeah, it's wonderful. It's such a great crew and very, very professional. And we've built a relationship over the years. So when we get together a couple times a year to film, it's like we're family, So It makes it easier that way than to, hey, got this new host and, hey, it's not familiar. But it makes, hey, you guys make me look good up there. So I'm just ecstatic to have that relationship.
And they give you lunch. I mean, come on. It's worth coming to Atlanta just to get a free lunch, right? I mean, I think that washes out.
No. Traveling is not worth for free lunch now, Doug. Come on now.
See, I've worked too long in terrestrial radio, okay? So I'm like, oh, wait, is there free food? I will drive miles for that. Okay. Well, and my name's Doug Turnbull, and it's good to be on with you all today. And we love to retirement is such a heavy and serious subject. We do love to have a laugh about it. And this story is not one to laugh about, but it kind of, you laugh at the ridiculousness of what could happen if this thing, happened, okay? So last episode, by the way, we talked about having preparation for retirement. We compared that to NASCAR driver William Byron not bringing an extra change of clothes in case he won the Daytona 500, and sure enough, he did. No driver has ever told me that they've ever actually brought one, by the way, either. But this time, we're going to talk about an asteroid that had a higher than normal probability of hitting the Earth. They found this, it's called YR4, or the asteroid is called 2024 YR4. All right, they found it last year, and at some point, it had an over 1% chance of hitting the Earth. And December 22nd, 2032, which, Adam, I know you do all these different retirement and tax calculations in the office. I have no idea how they could look at an asteroid and say, in 7 years, 7.5, 8 years, it's going to hit. But anyway, they have now decreased, the researchers at NASA have. The Jet Propulsion Laboratory has said it's now more like a 4/1000% chance that it'll hit in December of 2032. However, the moon still shares a 1.7% chance, way higher, that it could be graced by this 2024 YR4 asteroid in 2032. Got all those numbers right? Okay. So, Adam, it makes me think about planning for financial disasters or maybe some financial near misses that you've seen in your career there, and you've been in the business over 25 years. So how does someone, I guess, first plan for these, right? Like, hey, just in case the market crashes, just in case my house catches fire. Like, what are things that you recommend people do to not get, hit by the financial asteroid?
Well, first off, I hope we don't get hit by an asteroid anytime soon. It's weird how that date is the same time where Social Security starts not having enough receipts to pay out 100% of the benefits, 2033. At least that's in the range of what they talked about. Holy moly, don't get me down that rabbit hole. But I'd rather not get hit by an asteroid anytime soon. I've seen those, Armageddon and Deep Impact movies. I don't like the results of those movies. So
no doubt.
But avoiding financial disaster, we got to talk about possibility. Yeah, there's a possibility that may happen. But what's the probability? Probability is low, very, very extremely low. So I like looking at probability. So we talk about financial disaster. What's more probable? Okay, the probability. I'd rather have a 90% probability that I'm not going to run out of money versus not even knowing that number to begin with. So financial disaster. I take three major things I look at. Number one, running out of money. That's a big financial disaster. Number two, having too much market risk because markets can take you down, and then having number three, exposure to future taxes that are going to be higher than current tax rates are today. Those three things is what I'd like to talk to you guys about today.
Well, for sure. Well, let's start with running out of money because that would be my biggest fear. As much as I don't love taxes, all right, my biggest fear in retirement would be just over my years of saving, not stockpiling enough. So how do you come up with a number and then help people stick to that goal?
Yeah, it's saving for, and that's all we do is specialize in helping people nearing retirement and in retirement. So we do this on a daily basis for people, but crunching the numbers to say, what have you saved? what kind of income streams, whether you've saved it in 401ks, IRAs, brokerages, savings accounts at the banks and credit union, having the income streams, maybe you have a pension from the military, maybe there's a state or city pension. Those are fewer and far between than they used to be. But, having an income stream like Social Security, those types of things. Maybe you're going to work part-time in retirement just to stay busy and have some fun. Looking at the income, the assets, and then crunching the numbers. What's the probability of never running out of money? We can take into account inflation. We can take into account taxes. We can take into account how the risk and return is in your overall portfolio to come up with some estimates of where that falls. The higher the number, the better. If it gets too high, that means we're not spending or enjoying it enough. That's where we start when it comes to how do you protect against running out of money.
Yeah, well, that's a big thing. Yeah, just trying to figure out these different factors. Now, then there's another thing that can help lead to financial disaster is too much risk. So how do you determine what the right amount is?
Yeah, everybody has a right amount based on their unique situation. And so when we talk about risk, we're talking about stock market risk. Many people I work with, they've lived through, and I actually started my career right when a dot-com crash was starting to happen. So
you beat me to that punch. I mean, 25-year career, 2025. Let's take the numbers out. That is right there. Yes,
I'm more like one of my clients at this point because I've been through all the hardships and the losses that came during that time. The S&P 500 lost 50% for 3 years.
That's crazy.
All right, and there was negative returns all 3 years. So now there were some asset classes that performed during that time, so let's not try to spell doom and gloom here. But for the most part, things went down, and it was pretty ugly. Then fast forward, we had multiple years where things went up, and then in 2007, in October 2007, market started to shift again. We had the real estate crash. We had all the liquidity issues. We had debt issues. We had a financial Armageddon. The world was going to end, and then our government pumped a bunch of money and bailed out all the banks, at least most of them. And so then March 2009, it came back. So in all those months, the market went down 50+% again. So if you take from January 1st, 2000 to the end of 2024, it's about an 8% return annualized on the S&P 500. That's all the good years, bad years, and ugly years. So if you've experienced that already, I mean, that was a long time ago. And you were earlier in your career if you're retiring now. So to lose 50% when you had half your balance in your 401k and you still had 15 years to work, that's one thing. But if you lose 50%, not saying that's going to happen anytime soon. I'm not saying that whatsoever, Doug. But if you lose 50% when you have 2 or 3 times the amount you had, say you had $500,000 in 2008, you lost 50%, that's $250,000. That's a lot of money, but you have time to make it up. If you have $1.5 million and you lose 50%, that's $750,000. You don't have the time to make that up again. So I see a lot of times people have too much risk, and that's out of their control because the markets are going to do what the markets are going to do, and it doesn't make sense to have all of your eggs in one basket when it comes to having too much market risk.
All the eggs in one basket, even though it gains a lot over time, you may have only a shorter time to realize gains like that. You don't want to have too much there. And then exposure to future taxes. I know taxes is really one of your main pillars there at Wolf Retirement Navigation, Adam. So how do you help people navigate the ever-changing minefield of tax code?
Yeah. Oh, yeah. So wow. We're at a very low tax rate environment now. Historically, as a country, it might not feel that way, because we had to, especially this time of year when you owe. If you're not getting a refund back, you're owing. So it might not feel that way. But in retirement, it's the number one expense for most people. For most people, it's still federal taxation is the number one expense. Now, we are at lower brackets, tax rates of those brackets, and income within those brackets are a lot lower than they were back in 2017. And that means that if we have any kind of increases in taxation going forward, when now you're retired and you're pulling money out of these tax-deferred vehicles like 401ks that you had that haven't been taxed yet, because that's what you were told to do. We were told to put all the money that's all they had, 401ks and tax deferred 401ks, and not a lot of people did the Roth tax-free stuff. So now you have to pay the taxes on the way out. You don't have a guaranteed tax rate of what that's going to be 5 years, 10 years, 20 years, 30 years from now. So it's up to the government to tell us what the tax rate's going to be in the future, and that's out of your control. To me, that's a lot of risk. So we need to get ahead of that. We need to know what it is. And if it makes sense to make changes to your current plan, we need to start to shift that money to tax-free places.
Tax-free places, yeah. So that's something, you just going back a little bit, it's your number one expense usually in retirement. That is just eye-opening to me. Even if the market gains, if you're still having to pay a ton of taxes on that, not doing things in the right order, or maybe you're getting bumped up to a tax bracket because you're having to take out of a pre-qualified account or a qualified account, then boy, that can really jack things up, so to speak. So,
yeah, and also one thing, that's just if taxes just normalize to more historical levels. But also think of this. We are now paying as a country almost $1 trillion a year in interest on the debt.
Gosh.
Okay, so what is the government going to do? We can, DOGE can get in there and cut as much as it can, but it's not enough. So they're going to have to make spending changes and major cuts. But what else are they going to have to do to make the math work? They're going to have to raise the taxes. So will it be all, a lot of taxes at one time? I don't think so. But over time, higher taxes, I don't want to be involved with that. So what can we do now to reduce as much as possible and get ahead of it? It's all about planning and all about being prepared.
Preparation indeed. And we talked about that a bunch also in the last episode. So whether you're worried about running out of money, having too much market risk or not, or maybe not enough market risk, depending on what your portfolio is like, or being exposed to too many taxes in the future, Adam, if someone is worried about those things and wants to speak to you, how do they start that conversation?
Yeah, you guys give us a call or head to the website, wolfretirement.com. Ask Andrea, Robin. They'll set you up some time with me, and we'll go and get it all. We'll start from the beginning and take you through it.
Robin's great. She always sets up our appointments here to record Jacksonville's Retirement Coach. So you need to jump in with that. You can go to wolfretirement.com or even dial up the office, 904-944-5828. And Adam, I know you and the team start out with that complimentary call. There's a Retire Smart plan. I mean, this isn't just answered a couple of questions that, okay, here's what we're going to do. You actually have a method to that madness and then tailor that plan to every single person because they're all different.
That's right. That's what we take you through the process. Everybody's different. Everybody's unique, but there's major risks that we have to, check off that at least they're addressed. What can we do to tweak things to make things more efficient and more tailored to you, to where you do not have to work anymore unless you choose to?
Adam has lived through all this, and he is not a retirement age. So if you're on the doorstep of retirement there, you've lived through these big bubbles and busts and recessions and strife. It's nothing that you haven't seen before, and you know that there are ways to plan around it. So get that conversation started at wolfretirement.com or dial them up, 904-944-5828. Adam, thank you so much for walking us through that and reminding us of the ups and downs and the things to look out for.
Yep, as long as we stay away from that asteroid, Doug, I think we're going to be in great shape.
What happens if it hits the moon, by the way? 1.7%. Like, I wouldn't play Russian roulette with 1.7%. I feel like that could be pretty bad.
Yeah, all those sci-fi movies, we're in trouble.
You're closer to the coast than I am, so if the tides get messed up, it's going to hit you first, man.
We'll move our office further inland. That's what we'll do.
There you go. Watch out. Watch out. All right. Well, he is Adam Wolf, not the astronomer, but the president of CPA and CFP and Wolf Retirement Navigation. We thank him. We thank all of you for listening and helping us wade through these really tough topics that we can still laugh about and still have optimism about. And we thank our producer, Daniel Salerson, who gets us all ready and put out the show. Be sure to check out Wolf Retirement Navigation on Facebook and on Instagram. They put a lot of great material out there, and we're putting out some more clips of the shows, too. And if you know someone in your circle that you think needs to hear about this, please share the links with them. We're on Apple, Spotify, and under the media tab at wolfretirement.com. I'm Doug Turnbull. He's Adam Wolf. We thank all of you for listening, and we'll have another episode coming your way soon of Jacksonville's Retirement Coach.
Investment advisory services offered through Coil Capital LLC, a registered investment advisor. Wolf Retirement Navigation LLC and Coil Capital LLC are not affiliated. Investing involves risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss in periods of declining values. Opinions expressed are subject to change without notice and are not intended as investment advice or to predict future performance. Past performance does not guarantee future results. Consult your financial professional before making any investment decision. This information is designed to provide general information on the subjects covered. It is not, however, intended to provide specific legal or tax advice and cannot be used to avoid tax penalties or to promote, market, or recommend any tax plan or arrangement. Please note that Wolf Retirement Navigation LLC and its affiliates do not give legal or tax advice. You are encouraged to consult your tax advisor or attorney. Annuity guarantees rely on the financial strength and claims paying ability of the issuing insurer. Any references to protection or benefits or lifetime income generally refer to fixed insurance products. They do not refer in any way to securities or investment advisory products or services. Fixed insurance and annuity product guarantees are subject to the claims paying ability of the issuing company and not offered by Coil Capital LLC. Florida Insurance License Number W016816.